Well, I think we should go gathering like Fox.
Chapter 5.
Ready? Bring this meeting to order. Start with the pledge.
Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, roll call, please. Present.
I'm here.
She said big.
Sorry. Oh, he's not here.
Councilmember Reader.
Here.
Councilmember Graham.
Here.
Councilmember Jackson.
Here.
Councilmember Brickner.
Here.
Councilmember Paparad. Councilmember Finn.
Present.
Councilmember Bozak. Advisory members Leslie, Stacy, and Keith. Okay, we have to start with approval of minutes.
Make a motion to approve the November 17, 2020 minutes.
Second. Okay, all those in favor signify by saying aye.
Aye.
Opposed, same sign. Okay, motion carries. And now we'll move into the reorganization for 2021.
I would like to nominate Laura Blaney for Foundation President. Second.
Okay, I appreciate that, thank you. All those in, we don't need a roll for this, right? Are there any other nominations? Okay, all those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. I'll nominate Councilman Mike Jessen as Vice President.
Second.
Any other nominations? All those in favor signify by saying aye.
Aye.
Opposed, same sign. And Mike is the Vice President.
Thank you.
All right, we'll move into new business. We have a resolution transferring foundation earnings transfer for $4,770,559, which covers our budgeted amount.
Yeah, this is from the holding account to the budget account.
I'll make that motion.
Second.
Okay, we got a motion and a second. All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries.
Any questions?
Anybody have questions? Okay, we also have our scope of services contract for Cat, Sapper, and Miller. Should be in your packet. Does anybody have any questions about that? Do you want to talk about this a little bit, Vicki, if anyone has any questions?
Well, this is the agreement with your auditor, Cat Sapper Miller, and they will be auditing the 2020.
So Cat, Sapper, and Miller will be auditing our 2020 financial statement.
And they are already under contract at an agreed-upon amount, right?
Yep.
Okay.
Do you need a motion on that?
Yes.
I'll make a motion.
And a second.
Second.
All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. Okay, now we will move into our Capital Cities presentation. Thank you for driving up, Amanda.
Yep. Good evening, everyone. My name's Amanda Black. As you know, I'm with Capital Cities, and we serve as the co-fiduciary on the foundation assets. So I have a couple things to report tonight. First, I'm going to give you a really quick kind of overview of the document you see on the screen and the one in front of you. It's a stapled handout that says 2012 Review and Outlook. I'll use that to set the stage for your actual foundation's performance, and then we'll discuss anything from there. So looking at page 2 of this deck, this is just a review of the markets, what happened in 2020. After the first quarter, when we came to you talking about March 31st returns, we saw broad equities down over 20%. I don't think any of us expected where we would end the year. But if you look on this page, you can kind of see that in the second, third, and fourth quarters, we had 3 quarters there of outperformance of really all markets, and that led to really exemplary performance in the foundation, which I'll get to here in a second. I'm just going to give you a few takeaways on each of these pages. So on page 3, this is more of a kind of historical look back, calendar year by calendar year of broad markets. Again, this is not your portfolio, this is broad markets. 2020 is there at the far right. You can see that the broad stock market, as measured by the Russell 3000, was up 20.89% for the year. Non-U.S. markets trailed a little bit, but were still very positive. Broad fixed income was up 7.5, and then cash was up 0.67. Interestingly enough, that cash return, all of that happened in the first quarter. As we now know, cash is earning basically nothing because of the Fed funds rate. On page 4, really this is a quick overview of really the unprecedented monetary and fiscal policy response that we saw after COVID kind of gained ground in the first quarter. So central banks across the globe, including the Fed here in the U.S., basically lowered rates to make money easier to come by, which spurs economic growth. So here in the U.S., we saw the Fed lower rates to 0%, and then perhaps even more importantly or more materially in terms of an outcome was the fiscal policy response that we saw. The PPP grant and loan program putting money into the hands of consumers and businesses and even foundations and not-for-profits across the country to kind of offset the fallout from the pandemic. On page 5, we often talk about yield curve because it's really impactful to fixed income returns, and your portfolio has a large percent in fixed income. So a Treasury yield curve basically just shows you what yield you can earn at different maturities of Treasury bonds. So the orange line here represents where we were at the end of 2020. So basically, this shows you that compared to where we were at the end of 2019, which is the green yield curve, rates fell dramatically. So when the Fed lowered rates, the Fed funds rate, other fixed income followed suit, including Treasury bonds. So that fall of yields across the yield curve was actually very beneficial to your total returns within fixed income. But now going forward, we're looking at more muted returns because yields are so low. Now, with this said, even now this chart has gotten stale, and we've seen rates start to increase further out on the maturity spectrum. So, for instance, like if you look at the 10-year section, a 10-year Treasury bond at the end of the year, that orange kind of curve, was yielding about 1%. Now it's 1.7%. The 30-year was about 1.5. Now it's 2.4. So rates have gone up dramatically, and we've actually seen some negative returns in fixed income here in 2021. So I will bring you up to speed on that in a second. On the next page, this is really, I think, an important chart because it explains why the markets were doing so well when it didn't feel like everything else was going so well. So what I mean by that is, the COVID pandemic has affected jobs, it's affected the economy, it has affected individuals and families and small businesses, but yet we see these, really amazing returns in the stock market. So if you look at this chart, if you look at the column on the far right, and this is page 6, this shows you the composition of the S&P 500. So that's the broad U.S. stock index. And what I want you to look at here is that 50% of that index is comprised of healthcare and technology companies. So those companies really did really well in 2020. On the other hand, if the chart on the left, the column, shows you how sectors comprise GDP, and in the middle, how sectors comprise employment figures. And in those columns, you can see that government, agriculture, materials, and industrials represent, almost 50% of those measures. So that really explains that dichotomy between stock market returns versus the economy and jobs. On page 7 and 8, as we look ahead to what themes we think will be shaping the investment markets in 2021, we do think central banks across the world, including in the U.S., will continue to keep rates low. We think the COVID kind of pandemic will continue to be a daily headline. We're very hopeful with the vaccination rollout that that it's being contained and that things will continue to return to normal. But of course, there's always concerns of if there are any surprises on that front. Of course, that could rattle the markets. On page 8, something else that you've probably heard a lot if you're looking at business headlines, that is equity valuations. So what I mean by that is that the price you're paying for a stock, for the earnings of that company, those valuations have crept up and up and up above their historical averages. So on the one hand, you might have people saying that perhaps we're reaching a bubble. On the other hand, with the Fed funds rate so low and so much demand for investment and so much cash on the sidelines, many people would say that there's support for these current valuations. This is why we have so much diversification within your equity managers, but this is a theme that I think we'll be talking about throughout the year. On the next page, so with all that in mind is kind of looking back as to what happened and looking ahead to the themes that we think will kind of be on the forefront of investment topics. We did want to talk about our proposed calendar for you. So here in this meeting, we're talking about, what happened and what we're looking at. In the next meeting, we would take those themes and apply them to a fresh look at your portfolio construction. So we would do an update on your asset allocation study. That's where we look at the mix you have between stocks and bonds and what the expected return is on the portfolio. And then we would talk about whether we have any recommended changes for you. The meeting after that, we would do an investment policy statement review. And then in the November meeting, we would do the fee analysis that we do on an annual basis. So let me pause here before I dive into the portfolio performance and see if there are any questions on this or if any other topics on this.
Does anyone have any questions? Okay.
Go ahead and cover performance then. So there you go, thank you, Vicki. So we're into the bound report here. I'm going to skip the market review because I already kind of talked about that, broadly, looking back at 2020. So on page 2, this is where we have the summary of your investment portfolio of the Porter County Charitable Foundation. You ended the quarter, and again, we're going all the way back to December 31st of 2020. You ended the quarter at just over $188 million. That represented a return for that fourth quarter of 6.4% and a return for the 12-month period, so the calendar year 2020, of 13.6%. I'll show you how that compares to your benchmarks in a second, but obviously that's really wonderful performance after a very difficult beginning of the year. I will tell you that every single piece of your portfolio was additive to that return. Every one of your underlying investments was meeting or exceeding expectations, and that's reflected in that stoplight grid at the bottom where you see all of those green stoplights. I will give you a quick update on where we stand as of today, because here we are all the way almost through the first quarter of 2021. Your market value as of last night's close was $189,775,567. That represents just a slight return here in 2021, but positive nonetheless, so almost a 1% return. Now, I told you I would kind of talk about fixed income. The fixed income market is really struggling in 2021, and as you know, that is basically 60% of your portfolio. So I do think it's very positive that we have a positive 1% return here while the fixed income market is struggling. So let me give you some numbers on that. This is just broad market, not your portfolio. The broad U.S. fixed income market is down about 3.5% year to date. U.S. credit, so corporate bonds, down 4.7%. U.S. Treasuries down 4.2%. Non-U.S. bonds down 6%. And long Treasuries, so like the 10 and 30-year Treasuries, are down 13.6%. Your fixed income managers are down 2%. So even though your fixed income is slightly down, they are adding considerable value over the market. The 40% that you have in equity, however, is doing quite well, and that's causing the overall positive performance year-to-date. So I thought that was a good kind of chance to just show you diversification at work, even though it's a very short-term time period. Now, back to the performance for 2020, which this report officially covers. Let's look at page 4. I want to show you just relative to benchmarks how you did, because really, any investors who stayed put in the markets were positive in 2020, so long as they didn't pull all of their money out at the end of the first quarter. But what I really think is a success story here is not only the strong performance, that 13.59%, but your valuation benchmark, so that's a passive benchmark that matches your asset allocation, that number was 11.29%. So I'm looking at the last year column here. That means that your underlying investments, your managers that you've selected for this portfolio, outperformed by 2.3 percentage points, which is really strong for a year. And then over a longer time period, if you look at the far right of that chart at the top, this portfolio has had an average annual return of 8.58%, which again tops your both of your benchmarks, that passive benchmark that I just mentioned, as well as the 5% bogey that you have. One more chart I'd like to show you is on page 6. This is where we take that, average annual return and we show it on a cumulative basis. So if we go back to, the second quarter of 2016, when this was put into place, we can kind of dissect what happened with money flow in terms of deposits and withdrawals versus investment gains and losses. And the end result of that is a cumulative return of 47.8% over that time period, and that reflects an investment gain of $62.6 million in the portfolio. So those are the key things I wanted to point out, but as you know, there's a lot of detail in this report about all of your underlying investments. I'm happy to answer any questions on that.
Anyone have questions? Mike, do you have any?
Do I have any questions?
Yeah, just being new.
No, I do not.
Keep it
How are we
coming, right?
How are we gonna spend it? Is that it?
Yeah, looking forward, there's a lot of discussion of more stimulus, tax increases, a lot of things that I think are headwinds for the market. So I'm just sort of struggling in my mind, especially with fixed income being where it's at.
Yep.
It's going to be a challenging year, I think, if these other things take place. So I guess that would be my concern, and as we work towards, reviewing our plan and everything else, I'm very interested to see, how we can sort of buffer some of that. But just wanted to get your thoughts on
Yes,
any of that.
definitely. First of all, I will say that, we look at your portfolio all the time,
Yep.
and we think it's in great shape.
Okay.
I do not think it's broken in any way.
Right.
Now, but we're always thinking, what might we do just a little bit
Yeah.
better? And that's what we'll be doing formally at the next meeting.
Okay.
I'll tell you, our internal investment committee at Capital Cities, we have a meeting on the calendar on April 12th, and the topic is what to do about fixed income.
Okay.
Because, on the one hand, you've got rates creeping up on the long end, and it kind of would cause you to shy away from taking on interest rate risk. But if we sit here with a lot of assets in short duration fixed income, you're earning nothing. So we have to think about what role do we want fixed income to play for you.
Right.
And when it's 60% of your portfolio, it actually has to play a few different roles. It has to be a ballast and diversifier against equity, but it also needs to earn you a little something, or there's no point. So that's the kind of dynamic that we're debating. And then you'll hear our formal outcome of that at your next meeting. And I can tell you right now, I don't think it'll be materially different from what we're already doing. And even, like I said, just seeing these couple months of 2021 and seeing your fixed income holding up so much better than the market, further kind of gives us confidence in the strategy that's in place.
Good. Well, thank you. I just
I agree.
It's just an interesting time.
It really is.
What's the outlook on how long the fixed income problems are going to last?
Forever.
Well, the Fed says that they'll keep rates low indefinitely, yet rates are creeping up because of fears of inflation that's inevitable when you have so much policy response, so fiscal and monetary policy. So the question is, will the Fed actually keep rates low? Will inflation become a problem? Will they have to lower, or I guess raise rates? Ultimately, we want rates to be higher because you want to earn those yields. So
But you want to get there in an organized way.
you want to get there in an organized way. That's absolutely true. I do not have a crystal ball, but I will tell you, I do not buy and sell bonds on a daily basis, or even, we help you pick managers who do that.
Yeah.
And we do have a lot of confidence in what they're doing. They're looking at these markets every day, and they're making decisions. They might say, now, do I really want to hold this, whatever, Johnson & Johnson bond at a 5-year maturity, or would I rather be sitting in the 2-year maturity bond? And they're making those trades every day. So even though you don't see a lot of activity in terms of swapping out funds, there's lots of activity every day in your portfolio.
Thank you.
Sure.
It's real interesting, too. Without this foundation, we wouldn't have any equities right now. So
Right.
we'd be making
Exactly.
nothing,
Exactly.
pretty much.
You'd be negative
So, yeah.
this year. Right.
Would have been negative.
This foundation has been a fantastic
Oh.
tool for the county. Any other questions or comments?
I guess just to reiterate that, Laura, I mean, this all began in 2016. Prior to that, I think with the hospital proceeds, we were at 1% or less
Less.
on a typical
Yeah.
typical basis. And as I'm reading this, it's showing that since inception, it's been at 8.58%. And so 8.58% versus 1% or less. And since inception, we've earned $62 million on the investment. And I think it hasn't always been comfortable or easy, and there's been some question along the way at times, but I think having a solid strategy in place with the help of Capital Cities as our guide, I think we have stayed the course very confidently, very conservatively, but also very successfully. And I don't think that should be understated or taken for granted, frankly. I think it's been pretty terrific.
Anybody else? All right, do you want to talk about 2021 outlook? Scott, do you want to start with going over that legislation?
Yeah, I printed off for everyone the House Enrolled Act number 1407. The bottom of page 2, the top of page 3. This isn't law yet, but it seems to have passed both houses unanimously and is looking like it's headed towards potential approval. But basically, what this would allow is that some of the internal, maybe the last bit of internal struggles that Capital Cities had with us. For those of you that have been around for several years of these presentations, one of the concerns has always been foundations are normally working on a spending policy. That spending policy is a certain percentage. It's 4%, it's 5%, it's 6%, and you're working off of that. You develop your spending policy in conjunction with what you think your portfolio is going to generate, kind of more along a very long time horizon. And so you kind of set your portfolio up, you figure out that, over the long term, we're going to be making 4.8%. That's kind of what the crystal ball says. We have a spending policy up to 4% or 4.2 or whatever the case may be, and that's kind of how the foundations work, and that's how I think Capital Cities or anyone is used to dealing with. And because we're a little bit different and we're a statutory creation, we haven't really been able to do that, and our response has been the legislation controls how much we can have of earnings in a given year. And then we have set up, part of the reason why we had to do the resolution earlier today, we have a holding account that's kind of our safety net. Then that money goes from the holding account to the budget account. And right now, I think we're something around, our resolution for the board is something around 3 times whatever that finalized foundation budget is, to kind of have in reserve, because this would be obviously a large hole to cover up if in fact we had a problem with a given year on a return. This potential legislation would be able to get us back to something a little bit more, that the final piece that makes us really can put together our spending policy along with smoothing. The two go hand in hand. So as you can see, and I'm going to skip to subsection 2 because this is what fits us right now. In the case of a foundation that was established less than 10 years ago, an interim spending rate of up to 5% multiplied by a moving average consisting of all available quarterly market values since the date the foundation was established. So instead of having a situation where this year we made 13-point-something%, and of that we can have the first 5% that's going into our holding account, then we do our transfer. This would be a scenario in which we have a running average by quarter of our corpus amount, and then this board, along with Capital Cities, would develop a spending policy, and that spending policy would be utilizing what our current averages are for our corpus, with an eye towards what our current portfolio would produce on basically a long time horizon, get those two to match. So in other words, I'll make numbers up for a moment. Let's say ours is 4.8% on, basically a 20, 30, 40, 60-year timeline is what we think this portfolio with its current diversification is going to produce long term. Well, then we would maybe potentially come in, look at what a 4.2% or a 4% spending policy would produce, and then with the hope that because we haven't gone all the way to maybe our entire amount that we were able to, that 5%, because I think right now our long-term isn't 5%, I think it's 4-point-something. So it would allow there to be that extra to add back to principal so that we're dealing with inflation long-term, but it also allows us to have a very steady number year after year as far as what this foundation is creating. So on the good years, on a year that we made 13%, and we had, let's say, I make up a 4% spending policy, all that extra money would still be going to principal. That would be potentially moving the average of that corpus up over time. Obviously, when you're averaging this many quarters together, you're not going to get a big up or a big down in any particular year or any successive quarters. But over time, that number would potentially be rising because we would be below our anticipated investment return. And from a county standpoint, the budgeting would become more streamlined because the numbers would be moving. They would move, but it would be very small. Instead of maybe $6.2 million, you're going to get $6.1 million or $5.9 million instead of $6.2. And so it's much easier to consistently budget against. So this was an option. Like I said, it's not law yet. Assuming it becomes law, this board will have this as an option in its tool bag to be able to say we want to opt into this. We want to go into this kind of more of the last piece to make us really walk and talk like a foundation. And then it would require this board to come back and say, all right, with this new way of looking at it, we need to come up with a spending policy. And then, as Capital Cities is talking about next month and next quarter and the quarters coming up, working on our internal investment plan and our diversification, they're going to be saying, on a long-term basis, we think this is going to make 4.2%, and if this board comes in and says we're going to do a spending plan up to 4%, then we're going to be able to look at those numbers, and then we're going to have more consistency from a budgetary standpoint, but also allow us to add back to that principal over the long period of time so that we can basically the dollars that we're dealing with today are the same value 20 years from now. So that's what this legislation allows us to do, and it's an opt-in at this point, or an opt-out. I'm assuming that this gets passed in this current format. So that's one of the options for the foundation, for this board to mull over. But I think it's, fairly significant difference. I think some of the numbers that Capital Cities kind of ran through, instead of maybe being stuck at, right now, at 5% we made $8.3 million is what we're actually transferring over to the holding fund. Well, in this particular, if we had a spending plan, we wouldn't be getting $8 million, but we might be getting, say, 6.5, but we know the year after and the year after that, we're going to be in and around that number pretty closely to allow us to budget against it, which would allow us to not have to have the holding account any longer. So I don't know, assuming we transfer 8.3 and we put 4.8 in the, I don't know what we would have. It's around 9 or 10 million, 8 to 14 million that we'd have in the holding. So we'd have 14 million in the holding. We have our budget account, with the budget account. So we have about 9 million, okay, in the holding account. And if this passes and this board opts into this, that would free that money up. We wouldn't need to be stockpiling 2 and 3 and 4 years of foundation money in case we had a bad year, so that we could plug that gap. Because right now, I think the foundation budget's almost 4.9. So it's a $5 million hole. If in fact we had in our current format, if we had a bad year and we got nothing, like
2018,
2018,
Right, the beginning of
we got to fill that $5 million budget.
It was a tight year,
which is
Yes.
why
very tight year, remember?
Yep.
that's why we have to have the holding account. And then we were still young enough at that point in time, we barely had that
Mhm.
set aside, and luckily everybody was so conservative at that point to hold it back. But, as this budget grows and as we try to use it,
Well, and the things that come out of this budget are important. I mean,
Oh.
jail medical, insurance,
the non-for-profit.
our non-for-profits,
911.
911. We would have a real problem.
Yeah, $5
Yeah,
million
the big
in our
items.
budget is a lot of money to
Big
come up
items,
with
yep.
if it were gone. So this is a possibility. What's exciting to me is I think it actually puts Capital Cities and Amanda in a position that they're much more familiar with. Work on your spending policy in relation to your investment policy. The two go together, and they work like that. This has always been kind of the weird...
I remember asking Amanda, how many other foundations do it this way? 0. That was great.
I just think it's a natural evolution of this foundation. I think when it was passed, we were the first ones.
Yep.
There's now more foundations that are being formed in the state. We found that out in the legislative session this year. This is becoming something more normal. But I think that if we want to be good stewards of the money and we want to spend the money, we have to figure out a way to where we can rely on it a little bit more. And, you have to match up the expectation with the spending plan. And it's been very hard for us to do that the way it is now. So to me, it's just the natural steps of this foundation, taking it to the level that we need to. And anything that brings more consistency to your plan, I'm all for it.
I think
That's what it's all about.
I totally agree. I think it's also important to note that this bill has passed both houses unanimously at this point with no amendments. The sponsors in the Senate include, it's bipartisan. I mean, we have both Ed Charbonneau locally and Karen Talion locally sponsoring this bill. So, that they all see the value of doing this for us.
And I think we can probably, after this meeting, get that, we can have the overlay of what we actually had each year, along with, if in fact this was available, what that would have looked like for us each year. And you'll see that, when you start messing with it, with the spending plan, you know, if we were at a 4% rate, we might have gotten a little bit more money, but it would have been, there wouldn't have been a year that we got nothing,
Right.
Right.
okay? But there's also years that we wouldn't get $8 million either. So, I mean, you're shaving off the highs, and you're also shaving off the lows.
And there was a year where we did get nothing.
Right.
Right.
So,
That's what started all this.
I think we can get that out to everybody, so that they can
Yeah.
kind of see the visuals.
Yeah.
I think that really
Email
helps.
to everyone.
Yeah.
And I think also, when we do that,
Yeah.
and Amanda, I hate to put you on the spot, because I don't know if you have it.
It's in the back of the.
Okay, do you know what our long-term investment rate is?
Yeah, so, Scott's exactly right. You want your long-term spending to be less than your long-term expected return to account for inflation and to provide some growth back to the corpus. Last year, when we looked at your long-term expected return, it was right around like 4.9-ish%. I will tell you that when we come to you next quarter and do that same exercise, it's going to be lower because fixed income expectations are so much lower. We're looking at 2.5% on fixed income, and that's 60% of your portfolio. We're looking at about 6.75% on equity. So the weighted average of that is going to be 4.0 or something like that. Don't hold me to that, but I will show you that next quarter. And we can do the math and we can show you those numbers. We can say, well, what if you take inflation into account at its full 2% expectation? What if you put in more of a cushion of 1%? You know, what does that mean? Does that mean you're looking at a spending policy of 3.5%, a 4%? And then we can kind of show you long-term, we can actually project out what that could mean for the assets, given kind of broad market expectations. So we could include that in our analysis next quarter.
I think that would be great to keep everybody, so and Laura's correct, in the back of the Capital Cities packet, in the back folder, if you open it up in the handout, you know, what we actually received from 2017, 2018, 2019, 2020, and 2021 is of almost 28 million, well, about 28.8 million. If we had this legislation from the beginning and we were averaging and we had, say, a 4% spending plan, we would have received in those same years 30.7 million. The difference being in 2019 when we got 0, we would have received 6.1 under a smoothing situation, but you will also lose, because you're taking the highs and lows off.
Yeah.
In 2021, instead of receiving 8.3, we would have received 6.4. So you're taking the highs, you're taking the lows off, but it allows, what I like, besides the internal mechanisms here at the county that make things more difficult, what's nice is exactly what Amanda was talking about. You're able to really do that final dovetail of what your expectations are long-term. You can factor in inflation, and then you can put your spending plan together so everybody's comfortable and that the principal's protected and you have that shield up for the inflation over long-term. So I think this board gets that extra step that they're able to do that right now. It's really difficult to have that final analysis because of the way we're set up. So there's just a lot of things besides just our internal logistics that make this work much better.
If I could just add, too, that you as a board, you look at your asset allocation annually. Other foundations look at their spending policy annually just to make sure it still jives. Now, because yours was statutorily constructed, you didn't really have any ability to change it, so that wasn't something we evaluated annually. Going forward, we would. So this isn't a set it one time and then cross your fingers. This is a set it and then look at it every year with updated expectations and data.
Yeah, if once we set the stability up, we still are responsible for the spending plan.
Right.
And that's where we put all, you know, we come to you folks, and that's where the magic all happens, so.
Yep.
And I think it also just helps really define everybody's appetite for risk, because now you're going to have all the factors at one point now actually fighting each other. We need X dollars. We think we need X dollars from a budgetary standpoint. We think we can make X dollars. We think inflation is doing this. what works, what doesn't work.
Yep.
And unfortunately, we just had not had that ability yet because of the way we're set up, so.
Yep.
I think we should set our next meeting before Amanda leaves, and it would be good to get it in before you guys start budget. We can decide if we're doing it.
Well, we
this
should
way.
be in May or June.
Yeah,
When's session over? April?
April, end of April.
So maybe May?
I think May would be a good point to come back, and
Yep.
we will know whether the legislation passed, and then this board can gather what additional information it needs before it makes its decision to opt in or not, and then that way too, before Capital Cities gets too much farther down the road on evaluating our current investment plan for this year, they have an idea of whether or not we're going to be doing this exercise or staying with the exercise we've been doing.
So May 25th, perhaps?
That's the day after Memorial Day.
I'm
So
gone, but go ahead, without me, that's fine.
does May 25th work for you?
Sorry, I was looking at the 18th.
May
The
gets busy.
25th. I have a different meeting already on the calendar that afternoon that is one I usually do. We could make it work, though. It's not perfect, if I had a say in it. I'll be in Muncie until 3 o'clock, so I don't know that I can.
You can't make it here.
Let's, do we want to maybe do the first week in June?
Yeah, that's what I was thinking. What
Yeah,
about
we can-
June 1st?
Accommodate.
I think it's important enough to where,
That's fine.
yeah.
That's fine with me.
All right, let's
What
set
day
it
was
for
that?
June 1st, it's a Tuesday.
Good.
Should we start at 4:30 this time?
Well, there would be no council meeting
Oh, there won't
behind.
be a council. All right, let's do 5 then.
It might be a little bit of a longer presentation
Yeah.
with the asset allocation and spending, just so you...
There's no council meeting after.
Oh, I see what you're
Yeah.
saying. Okay. Okay, so June 1st at 5 p.m. Perfect. Okay?
Thank you, Amanda.
Yeah, thank you.
Great year,
Thank
it's a good
Yes,
year.
it was.
Yep,
Thank you.
yep.
Thank you all. Okay?
Drive safe.
I will.
Everything.
Right.
Appreciate it.
Considering I had a great year.
Next on the agenda is the attorney's report, but I think we probably heard enough from him. Do you have anything?
Nothing further.
Any other matter that may properly come before
We have
the
these
board?
claims, or?
Yeah, we've got to approve these.
We've got to do that, too. All right, we've got approval of claims for Capital Cities. The fourth quarter,
So it's for 2 quarters.
Make a
Yep.
motion to approve the
Second.
$16,000 for the fourth and first quarter.
Second.
okay, we got a motion and a second. All those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries. And then we've got the,
Make a motion to approve $3,400 for the
Second.
118 invoice.
okay. And all those in favor signify by saying aye.
Aye.
All opposed, same sign. Motion carries. Motion to adjourn?
Motion.
All right. See you next time.